Be Wealthy and Smart, episode 1565.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about a lot of things going on in the market, but I do want to point out how gold and silver mining ETFs have soared, not only in September, but year to date. So first of all, the performance for the stock market in September has been pretty good. Although September is often a month where performance isn't good, this time the S&P is up 2.85%, the Dow is up 1.26% for the month, and the Nasdaq was up a whopping 5.34%. Year to date, the S&P 500 is up 13.2%, the Dow is up 8.54%, and the Nasdaq is up 17.04%. While those are pretty good returns, they're nothing compared to what's going on in the precious metals and mining markets. Silver looks like it wants to break out above its old highs back in 2011. And silver year to date, its spot price is up 61.5% this year, while gold's spot price is up 46% this year. But the real story is in the mining stocks, with gold and silver mining stocks going absolutely crazy and starting to look like crypto returns. VanEck Vector's large gold mining stock ETF, and full disclosure, all these ETFs are in our recommended portfolio, is up 125% year to date. VanEck's junior gold mining ETF is up 131.98%, almost 132% year to date. And their junior silver mining ETF is up 132.73% year to date. These aren't even full year numbers. For the month, all of those ETFs were up over 20%, with the silver junior miners being up 27% so far for the month of September. You might wonder, is that all there is, and is it over? But I actually think we're closer to the beginning than the end, and that's because silver prices in particular have been so suppressed for so long, because as an alternative currency, gold and silver tend to get shorted quite heavily to keep the price down so it doesn't compete with paper fiat money. That doesn't seem to be working quite as well as it used to by the usual suspects. Now, looking forward to what's ahead this week. On Friday, we are expecting the non-farm payrolls report to come out, and we may have a government shutdown. This administration is warning of mass firings of federal workers that could take place if a shutdown is not averted by Congress. We got good news in the housing market, with pending home sales posting a surprise increase for August. Now, I've reported that new home sales were up about 20%, but we also had good news for pending home sales. The National Association of Realtors reported that houses under contract increased 4% for August, which was much better than the Dow Jones forecast for no change. NAR chief economist Lawrence Yun said lower mortgage rates are enabling more home buyers to go under contract. In the Midwest, low mortgage rates combined with high levels of affordability are attracting more buyers compared to other regions. Borrowing costs declined during the month, with the typical 30-year mortgage rate falling from 6.75% to 6.58%, according to Bankrate. There's a lot of talk about this being a Goldilocks kind of market. Recently, Goldman Sachs released their prospect for the economy, saying that good earnings growth, Fed easing without a recession, and global fiscal policy easing will continue to support equities. Christian Muller-Glissman, Goldman's head of Asset Allocation research in London, said, markets have continued with their risk-on shift, supported by a Goldilocks backdrop based on optimistic growth expectations boosted by AI with dovish Fed expectations. While Goldilocks regimes with strong growth and low inflation can last for a long time, as seen in the 1990s, the current backdrop is different, as weak labor market conditions drive Fed dovishness rather than anchored inflation. He said, unlike previous Goldilocks periods, positioning hasn't reached very bullish levels. Flows into bonds, gold, and money markets stay strong, while surveys remain somewhat bearish. Only retail investors are more bullish, he said. We remain modestly pro-risk in our asset allocation. He also pointed out that the Goldilocks backdrop could meet a bearish scenario in one of three ways. Firstly, a growth shock due to rising unemployment rate or AI disappointments. Secondly, a rate shock from the Federal Reserve not delivering on more dovish expectations, or from long-term yields signaling more risk of fiscal dominance. Or thirdly, increasing pessimism about the prospects of the US dollar. Well, if the government does close down and President Trump lays off 100,000 people, that certainly would be reflected in the jobs numbers, I would think. So that would give us a weaker jobs report, possibly, and with the downward revision of 1 million fewer jobs than expected in the last year. It would continue to show a weakening job market, but the inflation would probably continue to be a little bit on the high side. So it's up to the Federal Reserve. Do they want to pay more attention to inflation, or do they want to pay more attention to the weakening job market? My sense is that interest rates still feel a little bit high, and that we're going to continue to get those rate cuts. The CME FedWatch tool is still predicting a 90% chance of a 0.25% cut in October. So we'll continue to follow along and see what happens and report back to you. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.